let's jump right into this explainer. We are living through some incredibly turbulent times in the financial markets right now, and honestly, it can be really tough to separate the daily noise from the massive underlying shifts that are actually driving the global economy. So today, we're going to look at those deep tectonic shifts, and much more importantly, we're going to figure out exactly what they mean for your money and your personal portfolio.
Okay, here's our roadmap. We are going to quickly cover the changing world order, dive into something called the Triffin dilemma, look at the history of currency shifts, break down the risks of U.S. dominance, and finally, wrap up with exactly how to build a resilient portfolio. Let's get started.
Section 1. The Changing World Order. The 30,000-foot view.
So let's start by zooming way out to look at the massive, repeating cycles of history. Billionaire investor Ray Dalio identifies our current conditions as a near-perfect mirror to the turbulent period between 1930 and 1945. Think about it. He noticed a convergence of factors today that we just haven't seen in a very long time. We've got massive money printing fueled by zero interest rates, significant political and social conflicts driven by extreme wealth disparities, and of course, the rise of a new global power, China, actively challenging the dominance of the United States. Dalio argues this isn't just random bad luck. It's a big cycle that predictably repeats every few centuries.
Moving into Section 2, the Triffin dilemma, the mathematical trap.
To really understand how these massive power shifts actually impact global markets, we have to examine the ultimate economic engine, and that is the US dollar. This brings us to a fascinating concept called the Triffin dilemma. It's an unavoidable paradox first identified by economist Robert Triffin way back in the 1960s. He warned of an unsolvable macroeconomic trap, basically stating that a single national currency simply cannot permanently serve as the world's reserve currency without eventually destroying its own value. Why? Well, because the domestic needs of the United States are always going to inevitably clash with the global economy's endless, insatiable demand for dollars.
Think of it like a giant global amusement park, where you can only use park tickets to buy things. Now, Sam is the guy running the ticket booth. If Sam, being the sole ticket printer, creates way too many tickets just to keep the rides operating and trade flowing, well, those tickets will eventually become completely worthless once people realize they're just pieces of paper, not backed by actual wealth. It's a classic crisis of confidence. Because of this, the United States is mathematically trapped between two absolutely impossible choices. On one hand, they can print dollars and run massive trade deficits to save the world economy and provide that necessary liquidity, but that comes at the cost of massive inflation and soaring debt. Or, on the other hand, they can stop the presses to maintain confidence and preserve the dollar's value. But doing that would instantly starve the global economy of capital and cause a massive crash. You literally cannot have both.
All right, Section 3, History of Currency Shifts, the 10,000-foot view.
Now, you might assume the dollar's global monopoly is just a permanent fixture of reality, but historical precedents reveal something pretty surprising. Data from the European Central Bank shows that the conventional narrative, the idea that the US dollar smoothly took over from the British pound right after World War II, isn't entirely accurate. If we track international bond markets, the actual transition away from sterling to the US dollar happened much earlier, right around 1929. And then, by 1971, due to the intense pressures of that Triffin dilemma we just talked about, the U.S. had to completely sever the dollar's link to physical gold.
It's important to realize this early transition wasn't just some sudden post-war political agreement. It was actually driven heavily by the rapid deepening of U.S. financial markets. Because the United States developed a really robust, highly liquid financial system in the 1920s, the dollar was able to swiftly overcome the massive, entrenched advantages that British sterling had enjoyed for decades.
Plus, historical data completely dismantles the myth that there can only ever be one top dog at a time. The 1920s and 30s actually operated as a bipolar system where both sterling and the US dollar coexisted and fiercely competed for dominance in the global debt markets. This proves that a multipolar currency world is historically completely normal. The total unipolar US dollar dominance we've seen in recent decades, that's the exception, not the rule. So a shift back to a multi-currency system is entirely possible for our future.
Down to Section 4, Risks of US Dominance, Dropping to Ground Level.
So what does the shifting world order actually mean for your personal retirement accounts? Well, 33%. Because of this long era of American exceptionalism and the massive rise of passive investing, if you just hold a standard US index fund today, your concentration risk is staggering. Just 7 tech companies currently make up nearly a third of the entire S&P 500. Let that sink in.
And that extreme concentration introduces some really severe vulnerabilities. Beyond just relying on a few tech giants, standard portfolios are highly exposed to wild volatility. There are growing fears out there of an AI spending bubble, and market commentators are even pointing to rumors circulating of a massive $610 billion circular financing fraud within the tech space. Add to that the fact that US valuation premiums are rapidly shrinking compared to their global peers, and the risk picture becomes incredibly clear.
Legendary investor Howard Marks really hit the nail on the head here. He points out that historically, if you bought into the US market at today's historically expensive valuation levels, your average annual return over the following 10 years was completely flat. We're talking bouncing between +2% and -2%. If the US market is mathematically tapped out right now, you absolutely need a different strategy.
Which brings us to Section 5, Building a Resilient Portfolio, the Micro Map. Now that we've mapped out these immense macroeconomic threats, from the Triffin dilemma all the way down to extreme tech concentration, it's time to build a practical defense. How do you actually protect your wealth when the world order is literally shifting beneath your feet? Let's look at some specific, highly effective ETF allocations that can help you construct a durable, globally diversified portfolio.
A really great starting point comes directly from JP Morgan's institutional research. They suggest that, yes, while the US still mathematically dominates global market capitalization, deliberately allocating about 25 to 30% of your portfolio into non-US developed equities gives you critical geographic diversification. You don't have to abandon the US entirely, not at all, but you do need to broaden your horizon to smooth out those inevitable performance bumps.
So how do you practically structure that? Using exchange-traded funds, or ETFs, you can build a highly resilient core and satellite approach. You start with a massive, globally diversified anchor, something like Vanguard's FTSE All-World Fund. Then you can add targeted satellite exposure to US equities for that extra growth. But crucially, to balance out the volatility of those stocks, you add stabilizing assets. We're talking a global aggregate bond ETF to act as a shock absorber during market crashes, and a physical gold ETC to act as a strict defensive hedge against the inflation risks we discussed earlier.
But to run this portfolio effectively, you absolutely need strict systems in place. First, apply the mathematical 100 minus your age rule to figure out your exact split between aggressive stocks and safer bonds. Use those bond ETFs specifically to smooth out the equity crashes. Hold on to that modest gold allocation to protect against currency devaluation, and arguably most importantly, periodically rebalance these assets inside tax-efficient accounts. This systems-based approach completely removes your emotions from the investing process and shields you from regional downturns. Before we wrap up this explainer, I really want to leave you with one defining question to help guide your financial future. The global landscape is undeniably changing right in front of us. The dominant currencies, the massive debt levels, the rising powers, it's all shifting. So take a hard look at your portfolio today and ask yourself, are you investing for the world order of yesterday or the world order of tomorrow? Keep that in mind. Thank you so much for exploring this with us.